Hi, welcome back to Joe Blogs. In today's episode, I want to talk to you about the stock market crash that is happening right now in China and the bailout proposal that's been put forward by the Chinese authorities. Now, if you've been following the stock markets this year, you'll know that they've actually been performing quite well, despite the fact that there are concerns about what's going to happen in 2024 with the global economy. Markets around the world have picked up. However, that situation has not been happening in China, and it's actually had its worst start to the financial year since 2016 for the last 8 years. And the stock market recently was at its lowest point for the last 5 years. So what's going on in China? Why are the markets down considerably compared with the rest of the world? Because this obviously isn't a global malaise. This is specifically targeted on China. So in today's video, we'll take a look at what's exactly happening in China and compare it to what's happening in the USA. We'll look at the like-for-like comparisons. We'll then have a look at what's happening in the wider Chinese economy that may be causing these fall in stock market values. We'll also have a look at what's going on in the property sector because that equates to around 25% of the total Chinese economy. We'll have a look at the proposed bailout facility that the Chinese authorities are putting together, which is rumoured to be 2 trillion yuan, which is around $300 billion. We'll then talk about a really interesting derivative product that was created in China over 10 years ago called SNOWBALL products. The Chinese stock market is different to the rest of the world. It isn't as freely available to everybody in China as markets are in other countries. And hedge funds don't really exist. You don't get people shorting the market in the same way as you do in other markets. However, a very interesting financial structure was created by Chinese traders called SNOWBALL products, and they are potentially sitting on losses of around $27 billion as a result of the fall in the markets. So we'll take a detailed look at what these SNOWBALL products are and what the risk is to the stock markets in China. And then finally today, I'll round up with my summary. So what I think is actually happening in the Chinese stock markets. What's causing this loss of consumer confidence and the exodus of the market from a lot of international investors? And what's likely to happen over the course of 2024? But before we get started on all of that, once again, I'd like to say thank you so much to everybody that sent me kind messages over the course of the last week or so, and also to everybody that's supporting the channel. If you've bought me a coffee or sent me a YouTube super thanks or signed up as a patron or a member, thank you so much. It really, really helps me. It does help to support the channel, so it's really appreciated. This chart shows the movement of the CSI 300, which are the 300 largest companies in China, dating back to the start of 2019. And what this shows is that from the start of 2019 up to the beginning of 2021, there was a large increase in the value of shares in China. And the index rose from around 3,100 at the start of 2019 to a high of more than 5,700 at the start of 2021, which means that over that 2-year period, the index almost doubled. However, if you look at the performance since the start of 2021, you can see that there has been a rapid and consistent decline in the CSI 300. And the index is now back down to around 3,250, which is the lowest point that it's been since the start of 2019 and means that the index has almost halved over the last 3 years. Now, one of the interesting things about the Chinese stock market is that a lot of the large companies, including many of the large property developers such as Evergrande, are actually listed on the Hong Kong stock market rather than the Chinese stock markets. And this is really a legacy issue when the Chinese stock markets were not really available to outside investors. And so companies that wanted to raise money internationally had to go to Hong Kong to do it. And this chart shows the movement of the Hong Kong Stock Exchange over the last 5 years. And as you can see, there has been a considerable decline over that period. 5 years ago, the Hang Seng Index was sitting at a level of around 27,500. However, it is now down to around 15,500, which represents a fall of almost 45% over the last 5 years. Now, in order to put the performance of the Chinese stock market into perspective, let's have a look at what's been happening with the S&P 500 in the USA over the last 5 years. And as you can see, over the last 5 years, there has been consistent growth in the index. 5 years ago, the index was sitting at around 2,700, and today it's trading at around 4,800, which represents an increase over the last 5 years of around 80%. This chart shows the movement of the Nikkei 225, which are the largest companies in Japan. And as you can see, over the last 5 years, there has also been consistent growth in the market. 5 years ago, the index was trading at around 20,000. However, today it's sitting at around 36,500. So once again, we're looking at growth of around 80%. So the data that we've just looked at tells us that what's going on in the Chinese stock market isn't the result of what's happening in the global economy. Generally speaking, over the last 5 years, stock market indexes are up considerably. You would have made a lot of money if you'd have put money into the markets 5 years ago, everywhere apart from China. So this tells us that the problems in the Chinese stock market are specific to what's happening in China. One of the main drivers for what's happening in the Chinese stock markets is what's happening in the Chinese economy, because when investors invest into companies in that country, they need to believe that it's going to see growth, that the economy will be growing, and therefore all of the companies will do well and their share prices are likely to go up. But the message that the Chinese stock market is sending to everybody around the world is that there isn't confidence, that people do not believe that the market is going to grow, and therefore companies are unlikely to do well. So let's have a look at exactly what's happening with some of the key indicators in China. This chart shows the quarterly reported figures in the annual GDP rate in China dating back to the start of 2021. If we focus in on what's been happening over the last 2 years, you can see that the general trend has been an increase in GDP from the low point measured in July 2022 of 0.4% growth. We've seen an incredible bounce back in China, and over the last 4 quarters, the GDP growth has been recorded as 4.5%, 6.3%, 4.9%, and the official figure released by China for the full year of 2023 was growth of 5.2%. And if we compare those figures to what's been happening in the USA, which is the largest economy in the world, you can see that the Chinese figures are considerably higher. And in the last 4 quarters, the annual rate of GDP growth was recorded as 0.7%, 1.7%, 2.4%, and the official figure for 2023 is 2.9%, which is almost half the figure recorded by China. And in terms of the outlook for 2024, the USA is expected to grow by around 2.3%. However, China is expecting to see growth of 5%. So what's happening in the stock market does look a bit puzzling if you take these figures at face value, because the numbers are telling us that China is growing at a rate of around twice the USA and is forecast to hit those same sort of numbers in 2024. So you would have expected the stock markets to be buoyant in China and not so much in the USA, but we're seeing the exact opposite of that. And that raises a question as to whether or not these figures are 100% reliable. So let's have a look at what's going on with inflation. This chart shows the monthly publication of the 12-month rolling inflation figure in China. And as you can see, unlike the rest of the world where we've been talking about high levels of inflation causing problems in the economy, over the last 6 months, China has actually been experiencing deflation. So this means that year on year prices are actually falling in China, which may sound good if you're a consumer that prices on the shelves are going down. But from a business point of view, that is a disaster, because it means that you can't pass on any increases in costs. And China has been experiencing cost increases because it buys in raw materials from the rest of the world. So prices have been going up around the globe, meaning that China's purchasing prices are rising. But if their sales prices are falling, that means that Chinese companies are going to have to absorb those losses because you just can't pass the cost increases on. And the other problem that it causes is that you can't increase anybody's wages. So you have to start talking to your staff about potentially either keeping their wages flat or even reducing them if you get into a long-term position of deflation. And as you can see, in the last 3 months, prices have consistently fallen. And this chart shows the movement in producer prices in China. And these are also referred to as factory gate prices. So basically, the price that companies are charging when goods are completed and are leaving the factory. And as you can see, in every single one of the last 12 months, producer prices have fallen in China. So that means that not just the sales prices on the shelves, but the prices that these companies are actually charging have gone down in every single month. And that tells us that prices are not likely to start increasing anytime soon in China, because there is a lag between goods leaving factories and making it onto the shelves. So the fact that China has experienced 2.7% fall in producer prices in December 2023 tells us that over the next few months, prices could actually start going down at a faster rate. So this becomes a really vicious circle, because as prices continue to fall, it encourages companies to reduce their factory gate prices further, and it becomes a death spiral. This chart shows the official percentage of the Chinese population that are unemployed dating back to the start of 2023. And as you can see, the current rate of unemployment in China is sitting at around 5%. And in terms of putting that into perspective, this chart shows the unemployment rate for the USA over the last 12 months. And as you can see, it's sitting at around 3.7%, which is considerably lower than the figure for China. And one of the key issues in China right now is the level of youth unemployment. People aged between 16 and 24 that are looking for work but can't find jobs. And this chart shows the rate of youth unemployment dating back to September 2022. And as you can see, between December 22 and June 23, there was a rapid increase in youth unemployment rates, and it hit a peak of 21.3% in June. Now, the Chinese authorities did not like this data. They didn't want the rest of the world analysing what was going on. So in July, August, September, October and November, no data was released. The Chinese authorities did not disclose the youth unemployment rate. And most recently, the figure for December 2023 was released, and it was declared that the youth unemployment rate had fallen to 14.9%, which was a considerable movement against 21.3% in June. However, the metrics for the calculation of this figure have changed considerably. They've now excluded anybody that's either in higher education or considering moving into higher education. However, the figures that we're seeing historically have not been adjusted. So what we're seeing here is not a like-for-like comparison. We're not comparing apples with apples. We're looking at a completely different metric. So basically, the figure is no use to us for December 23 because it doesn't tell us actually what's going on. All we're seeing is the Chinese authorities changing the way it's calculated to come up with a lower figure. And the concern from the market's point of view is that China is trying to mask what's actually going on. And as I've discussed in other videos, one of the problems in China is that they have a high level of education. A lot of people go through university. And what that's meant is that a lot of people now have high expectations that they are going to get a job in management. They want a highly paid salary to go with their new graduate situation. But unfortunately, there aren't enough graduate jobs available. So what we're seeing now is a lot of the youth in China are disillusioned. They're coming out of university, they can't find an appropriate job, and they're refusing to take jobs in factories, which is leading to high levels of youth unemployment and high levels of unemployment generally. And obviously that is a bad indicator in terms of what's going to happen in the economy over the next 12 to 24 months. As we've discussed in lots of previous videos, the property sector is highly important to the Chinese economy. It equates to around 25% of total GDP. So if China is going to have a good year in 2024, by definition, it needs the property sector to bounce back and start firing on all cylinders. But unfortunately, we're not seeing anything like that. There are no glimmers of hope in the property sector right now. In fact, things seem to be getting worse. And this chart shows the year-on-year percentage movement in monthly sales by the top 100 property developers in China. The scale on the right-hand side of this chart is shown in percentages and goes from minus 100% at the bottom to plus 50% at the top. And what this shows is that in 20 of the last 24 months, the big property developers in China have seen a year-on-year fall in their sales level. And in December 2023, sales were down 34.6%. which actually compounds on top of the 30.8% fall in December 2022. And if you look at what's been happening to the monthly sales figures over the last 7 months, the year-on-year fall has been more than 25% in every single month. So these figures represent an absolute disaster for both the property sector and also the economy in China. And this chart shows the year-on-year movement in the price of newly built houses in China. And the whole market is entirely dominated by newly built property. It represents more than 95% of all sales. The secondary market in China is virtually non-existent. And what this shows is that over the course of 2023, prices have only seen a rise in 1 month, which occurred in May, and that price increase was 0.1%. And in 10 of the last 12 months, prices have fallen. And in November and December, the price falls have been accelerating and hit 0.4% in December. So in terms of gauging what's happening in the property market, what we're seeing is a continuation of the fall in prices and the fall in sales, which means that the property sector is likely to continue contracting during 2024. And as that makes up such a large chunk of the Chinese economy, it indicates that the Chinese economy isn't going to perform well. So the forecast increase of 5% GDP in 2024 is actually going to need to be significantly higher for the rest of the economy to offset exactly what's happening in the property sector. Now, the problems in the Chinese stock market haven't been just happening over the last few weeks. They've actually been going on for quite a long time. And back in August of 2023, the Chinese regulators approved 37 retail funds to come in and buy shares. So this was effectively encouraging other companies in China to try to bail out what was happening by getting them to start buying shares to push prices up to bring the whole index up. But unfortunately, from China's point of view, that injection of capital wasn't sufficient to be able to save the market. And the Chinese authorities are now putting together a stabilization fund, which is estimated to be 2 trillion yuan, which is around about 290 billion US dollars. So this is a serious amount of cash. And what this is basically a lot of money that's sitting in offshore accounts that are owned by Chinese enterprises that will be repatriated back to China and used to buy shares on the Chinese stock markets. So essentially what this is a form of market manipulation. One of the basic principles of economics is that supply and demand set the price. If you have excess demand, so everybody wants to buy something, then generally the price goes up if there's a limited amount of supply. And equally, if there's an excess supply, if there's too much of something and people don't want to buy it, then generally prices go down. And the stock markets should be a perfect example of a true market, because there's only value in terms of the piece of paper that you're buying. You don't generally buy stocks and shares for some other reason. You're buying it to make a profit. So if a share price starts going up, it attracts in people, it encourages people to think something good's happening with that company. You buy it, you get on board, the price goes up, you make a profit, and then you sell it. And equally, if a share price is falling, then everybody is concerned that something bad is happening with that company, and you may see an exodus and the price continues to go down. But what we're seeing in China is a cancellation of that. The Chinese authorities are trying to push the stock markets back up by buying shares for reasons other than financial investment. They're doing it because they don't want the market to keep going down. And whilst this could stabilise the market for the short term, generally speaking, market manipulation doesn't last for a long period of time unless you've got an unlimited amount of funding. And even though $290 billion is a large amount of cash, it's not unlimited. And so the Chinese authorities may bolster the market, it may go up for a short period of time, but it won't solve the underlying problems. The reason that the stock markets are going down is because of what's happening in the Chinese economy. Snowball products, which are also called snowball structure income certificates, are a type of complicated derivative financial instrument that were created in China in 2010, the market for snowball derivatives was mainly limited to institutional and fund investors for the first 10 years. However, as these derivatives offer bond-like coupons to investors, they started to become more popular, and in 2021, as the pandemic and weak economy forced brokerages and investors to get more innovative, they gained in popularity, and it's now estimated that a significant fall in the stock markets in China could result in losses of around $27 billion for holders of snowball products. Many of these derivatives offer returns of between 15 and 20% to investors, and the structure of these deals is similar to option contracts, where you place bets on what will happen to the share price of underlying companies. However, the key difference with snowball contracts compared with options is that a snowball contract has two defined prices, called the knock-in price and the knock-out price. The knockout limit is the upper level of the share price, and if the underlying share price rises above this trigger point, then investors are taken out of the contract and paid off. However, the risk in the contract from the investor's point of view is the knock-in price, which is the lower limit that is set for the movement of the shares. And if the share price falls below this level, often set at a level of around 20 or 30% below the current share price, then this will crystallise a loss for investors. And this chart shows an illustration of how snowballs work. Now, please accept my apologies if you don't read Mandarin. I don't either, but you don't need to be able to understand this chart. This chart shows the movement in the share price of the underlying asset that a snowball contract has been structured around. The scale on the left-hand side shows the share price in Chinese yuan. The blue horizontal line, around 2/3 of the way up this chart, shows a share price of 100 Chinese yuan. The dotted line at the top of the chart shows a share price of 103, representing an increase of 3%. And the dotted line at the bottom shows a share price of 75 yuan. And the red line on this chart shows the movement in the share price over time. Now, under the terms of this snowball contract, an investor would receive a return of 20% over a 12-month period, providing that the share price, which is at 100 at the start of this contract, does not increase by more than 3% and does not fall in value by more than 25%. So the contract has been structured to provide a high yield to investors if the share price moves very little in value over the next 12 months. So it provides a nice return in the event of a flat market. If we now have a look at the movement of the red line, the red dots represent the monthly testing period, following which income would be released to the investor. So if we look at the movement of the red line, you can see that on the first testing date, the share price has risen to around 101 Chinese yuan. So that doesn't represent the knockout value of 103. And therefore, the investor would be paid their monthly interest because the share price is moving within the parameters that are agreed. On the second testing date, the share price has fallen back to 100, so the investor again would get the monthly interest. On the third testing date, the share price had fallen to around 85 Chinese yuan, so again within the agreed parameters, so the investor would receive their monthly payment. On the fourth testing date, the share price had fallen to 75 Chinese yuan, which is at the very lower limit of these parameters, so the investor would once again receive their yield. However, on the fifth testing date, the price had fallen below 75 yuan, and as this price is lower than the agreed parameters, this would represent the knock-in value and would crystallise a loss for investors. And just to provide you with a full explanation of how the snowball works in the event of share prices rising, if we ignore the drop in value in month 5, if the red line had stayed within the parameters, on the right-hand side of this chart, as it goes above the 103 level, that would actually represent the knockout value and would actually have led to a termination of the contract. The investor would be paid in that month, but the contract would no longer continue as the share price had risen above the upper limit of the snowball contract. So just to give you a real-life example, if an investor invested in the China Securities 500 index with an initial price of 7,000 points and an investment amount of 1 million Chinese yuan, subsequently, the market fluctuated wildly and the CSI 500 index dropped to 3,500 points. This would trigger the knock-in effect and the investor would bear a 50% loss, which in this example would be 500,000 Chinese yuan. So what's the summary and conclusion today? Well, I wanted to post this video because I think what's happening in the Chinese stock market is really interesting, because when you compare it to all of the other markets around the world, it looks very different. The fall in the Chinese stock market that's been seen over the last 3 years is not consistent with what's happening elsewhere. So this is not being driven by a general reduction in global demand. These falls are specifically down to what's happening in China. And as we've seen from the data in today's video, the fundamentals in China really don't look good at the moment. The wheels have well and truly come off the property sector in China over the last 3 years, and the fall in the value of the stock markets almost mirrors exactly what's been happening with property. But unfortunately, from China's point of view, it's not just the property sector that's causing them a problem right now. As we saw from the indicators we looked at earlier, inflation has now moved into a deflationary cycle. Prices are actually falling on the shelves in China. And unfortunately, from China's point of view, it's not just the prices on the shelves, it's also the factory gate prices, which tells us that this is not a short-lived phenomenon. It's not going to turn itself around over the course of the next month or two. And to consolidate those problems, unemployment is now starting to become a major problem in China, and it's getting worse. Now, we didn't look at the population pyramid in today's video, but if you've been following the channel, you'll know that there are also problems with regards to the reducing birth rate, the falling population, and the low retirement age in China, which is taking a lot of people out of the workforce. So all of these factors are pointing to a very difficult 2024 for China. The only thing that's confusing about the data we've looked at today is what's going on with GDP, because China reported 5.2% GDP growth for 2023, which was almost double what was seen in the USA, which is confusing. And for 2024, China is saying that it's going to hit 5% again, compared with around 2.3% for the USA. So based on those numbers, you would think that China is doing better than the USA, that the prospects for this year should be better, and therefore the stock market should be outperforming what's going on in the States. But clearly that isn't the situation. And what that tells me is that nobody really believes that the 5% GDP that's being talked about for China for 2024, and possibly even the 5.2% for 2023, are genuine figures. There are real concerns that China is going into a serious downward slump, and that's being reflected by the stock market. Now, the Chinese authorities have come up with this idea of putting together a fund to go in and buy lots of shares to push the price up. But that won't really mask what's going on, because obviously the whole world can see what they're doing. They can see that the share prices have only just started going up because there's talk about this fund. And if prices do actually start rising because China starts buying all of these shares, that doesn't tell us that those companies are doing well and the Chinese economy is on the road to recovery. All that tells us is that China is manipulating the market. They're going in and forcing up the price by buying those shares. So it's really defeating the objective of having a market. The whole point is that you can see if an economy is doing well. But if you're buying the shares just to force up the price, clearly that's counterproductive. So the overall summary of today's video is that the stock markets in China are telling us a story. And the story is that over the last 3 years, prices have come down significantly of all of the companies. That tells us that there are global concerns about what's happening with those companies. Those concerns are linked directly to the Chinese economy. China is trying to fix this problem by masking over it. That isn't going to work, and the fundamental issue here is that there are continued problems in the Chinese economy, and unless the issues are addressed, 2024 is going to be a very difficult year for China. So hopefully you've enjoyed today's video, you found it useful, informative and thought-provoking. If you've liked what I've said, then please give me a thumbs up. Thank you for watching this video all the way through to the end, and here's something to put a smile on your face.